Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
You know, it's been like a month, and what a way to get back into it with Intro Man leading us off as he always does. What a great guy. He's all reliable. I mean, it's good. It's good to see you, Frank. It's been a while. And
it's good to have you back.
No, it's a shame that it's just the two of us to start here. Maybe that's a good thing. It would have been nice to see the rest of the group, but various obligations and sicknesses will do that to people. So we'll have to wait till next week. And it is time for our quarterly best ideas stream. So we might have to extend this into 2 episodes so we can get some more pitches from the rest of the crew. Yeah, we'll have to hold down the fort today and go. Maybe we can go a bit deeper into our best ideas than we might have otherwise. Before we, I'm already rusty, but I got to remind.
Too much time off.
I got to remind. It wasn't time off, but I got to remind the people that you got to take a look down in the description below for our various links. Got lots of great stuff down there, including discount links to Seeking Alpha and Share Site. Go ahead and check those out. They go a long way towards helping the channel if you do end up signing up. They got free versions as well if you want to try it out. We got our Discord down there. And then let's pitch the merch shop. We haven't done that in a while. We got Karan's merch shop down there with some various Shameless Cloner merch, among many other nice niche value investing merchandise for purchase. So go ahead and check that out to support the community. Like, comment, subscribe, all that great stuff. That also goes a long way. If you're not willing to go to the links, at least tickle the like button for us. That would be super helpful. With that said, how you doing, Frank? It's been a while.
Yeah, I'm doing good. It's a shame the boys aren't here, but I definitely think we pressure them into a second episode so they can't hide their best ideas from everyone.
Yeah, these are the we get some pretty good viewership on these streams, and we get a lot of it out of it too. Just the exercise of going through whatever your best idea, or potentially looking at some newer ideas that you might not have done a deep dive on before. Like, it's good to kind of go through that exercise and get some critique or questions that you might not have thought of in looking at that company. So we definitely have a good time with it. What's new and any moves? I did not watch the previous 3 episodes since I was busy with a bunch of stuff in September. Good to be on the other side in October, but anything new in the Tabor household?
No, nothing too exciting going on around here. Keeping it quiet, just doing lots of writing lately. Between stuff I have to do for work and the newsletter, I've been sitting at a computer for a long time, it feels like, but most of it's enjoyable at least.
You got the little bit of a rebrand going, if I'm not mistaken, with the Lone Wolves project, right? When did that happen? That was pretty recent, right?
Yeah, I switched the name maybe about 2 months ago, but I've just put out 2 write-ups under the Lone Wolves brand. I narrowed it down. Previously, Seeking Value was the newsletter, but I narrowed it down to small illiquid companies. I really wanted to focus on that niche. It's what I like to focus on more myself too. So if I was writing about companies that really I wasn't overly interested in, it takes away of my research time. So I can kind of combine the two and write about companies I'm actually interested in. Maybe that makes for a smaller audience, but hopefully a more engaged audience.
It's leaning into your niche, right?
Yeah. lonewolves.substack.com for anyone interested.
Go get it. So is there still like there's a free version in the newsletter and a paid version? Is that how it is? Or is it fully paid now?
No, so I've taken it's half and half. So
right,
my write-ups will be behind a paywall. I keep the executive summary and the introduction, which gives the ticker out at least. Like, I'm not hiding the companies I'm writing about, so they still get access and can do their own research and a bit of a summary to it. But also once a month, I'm sharing other people's write-ups, so other Substack authors or just anyone that's interested and writes a quality write-up. I'll share that completely for free as well. So yeah, a bit of a mix for both free and paid
Good
subscribers.
deal. I got to ask, is there any goal to bring back the YouTube at any point at this point? Obviously, things can always change.
More so a podcast, I think, before
Sure.
a YouTube channel. I think I just like the format a little bit better, going deeper into something rather than cramming it into a YouTube video. Or alternative, maybe just like one high quality YouTube video per month, maybe a longer duration as well. But I'm kind of going back and forth on that. Part of my idea with Lone Wolves was to do a podcast and put it behind a paywall just for a week or two, and then release it via Spotify and everything else
Okay.
following.
Like
So
that.
to give a little bit extra to my paid audience as well.
I think sort of a freemium kind of model with the podcast. You get your quicker access. Yeah, I like that idea. Keep us posted, please, as I'm sure you will.
Of course.
Cool. Well, you wanna go ahead and dive into it with some best ideas. And best does not necessarily mean great; just means best. If best of the worst, that's still best. So we'll see what's going on. But there's been a lot of action in the market in the last really year, and stuff has come. A lot of stocks are at 52-week lows or even many year lows. So there's definitely some potentially much more attractive opportunities out there now than there might have been even last quarter. So it's exciting times for us bottom feeders, us value investors, looking for those contrarian bets, as it so often is the case. So yeah, I have a feeling like I know what you're going to be saying here, Frank, but I don't know, because you just did a write-up, a pretty comprehensive one. And is it that particular stock, or is it something else?
Yeah, I am. I'm going to do the most recent write-up I did for Lone Wolves, which is Atlas Engineered Products. I have another one or two that I'm assuming I'm going to have some time left over at the end, so have to do a less comprehensive best idea, or second best idea, I guess, after this one as well. But since this write-up was behind a paywall, I figure I can cover at least the main points of the thesis as well, and happy to answer any questions on it as well. As it's there's a lot of different moving parts to this idea, I guess, and a lot of macro factors that kind of come into the thesis.
What's that ticker again, so I can pull it up?
AEP on the Texas on the Canadian Venture Exchange. Atlas Engineered Products. Are you going to pull that up on ticker?
Yeah, I'm pulling it up right now.
I'll just fact check some of the market cap and stuff. Some of the numbers I read out were written maybe 2 or 3 weeks ago, so it might have changed slightly. What's the market cap at the moment, if you scroll down a bit?
In US dollars, it is $23 million.
Can you get it in Canadian dollars as well? As I kept all my numbers in Canadian, as it's just easier.
Okay, leaving it in Canadian, it's about 32.
Yeah, okay, that's perfect. I think, 32.6 when I wrote it, so it's gone pretty much sideways. All right, so it's essentially a wood products manufacturer, so exposed to the housing market, obviously. That's one of the big questions around the thesis. And then you also have the lumber prices that are a big part of that. So kind of both ends of what they're doing, the input and output, both they're exposed to some cyclicality, I guess, which is partly why this stock is really cheap right now. I don't know if this is going to be a bit too hard on you, but if you pull up the price of lumberjack just in a Google search, it's been a pretty strange past 2 years. Lumber prices usually sit around $400-$500 kind of on average, and have for a fair while. A little bit of like slow growth over the past decade or so, but they kind of shot up last year, I think to about 1,500, maybe even a little bit higher.
Yeah, I've got it right here. There's your lumber price graph.
Yeah, so some like extreme volatility, shot right up, come back down, shot back up. And this is both a good thing and a possible risk, I guess, for a wood products company, manufacturer. Obviously, it's going to make their revenue higher if they can pass on the cost, which they were very successful and quick in doing. The downside would be it could hurt their margins if they aren't quick enough to kind of pass on these costs, obviously some of the quotes they did within a month, they might have quoted it at $600 or so. A month later, the price is at $1,200. So there were some problems there, but overall they had a great year. Even 2 years from 2020 till now, they really done well at managing those costs and passing it through to their clients. Revenue is probably inflated due to that, but not to a large margin. I think they've done pretty well. So that 55 million, where it shot up there in 2021, that's partly in response to the lumber prices, but also some of their acquisitions. They're a typical roll-up. I guess a lot of the companies I talk about are these acquirers. They make 1 or 2 acquisitions each year. The industry is very fragmented. Roll-ups can go wrong in many ways, but the good points of a roll-up are when there's a very fragmented market. Great capital allocators, which I think Hadi Abasi, who's the founder and current CEO of the company, is a great capital allocator. Doesn't seem to have overpaid ever for any of the acquisitions. So that's one thing with a kind of roll-up company that you want to ensure is there.
And I noticed that even despite to your point that they're passing off the cost, their gross margins actually increased through 2021 and to today compared to some previous years. So up around the 30% mark in the last 12 months, which is pretty impressive given that costs were skyrocketing.
Yeah, and I would expect those to actually come back down. One of maybe the main risks, I guess, in my opinion, is there's a big shortage of construction workers in Canada. It's actually beyond Canada as well, but it only matters in Canada for them. So I would expect those margins to be hurt as to attract some of these construction workers moving forward. I think they're going to have to pay more for some of these labor costs. But yeah, that's probably the biggest risk in my opinion. I don't know how much that will affect them. My kind of stance on the housing market is it's not going to go down too much. Canada's in a position where they're overpriced, as I would expect most real estate markets are in the world at the moment. But there is a big shortage in Canada, and there is a big growth of population, the highest of the G7 nations. So although it'll probably come down as interest rates go up, I don't think it's going to fall off a cliff. And the demand's gone so back, they're 2 or 3 years kind of on a backlog of some of these orders that they want to do. So it's not going to disappear overnight. They've shown on the other side that they can manage the lumber prices. That's the other risk people would mention.
Right.
But yeah, that construction shortage is one I couldn't quite wrap my head around. And I did talk about that in the write-up that if there was a reason to pass, it would be because of that. But maybe they can manage that problem as well.
So it looks like they're raising debt to finance their acquisition, since their debt has gone from zero from a few years ago up to about 12 million now.
Yep.
So they're just financing through debt. I assume that's the plan going forward.
Yeah. So in the past, they've actually raised capital for a lot of
have they?
acquisitions. A bit of a mix. I have the exact numbers actually.
Yeah, I'm just looking at total shares outstanding, and they have increased a bit in the last couple of years, but not very much at all, from 57 million shares up to 59 now in the last couple of years.
Yeah, so a couple of deals they do within their acquisitions include mostly cash coming from debt, obviously, as well as some shares. So there is dilution, but the management have set out the current prices why they're trading what they think is cheap. They won't dilute shareholders. So it will come from either free cash flow, which they've kind of just reached a point where they probably have enough free cash flow to make some acquisitions, as well as debt.
Yeah, because I was looking at free cash flow briefly, and their last 12 months, about 7 million on, this is all Canadian dollars again, 7 million Canadian dollars versus, what was it, that $32 million market cap? So just from a free cash flow yield perspective, not so bad for a growthy sort of roll-up strategy.
Yeah, and again, the company's grown pretty fast. Revenues since listing in 2017 have compounded at 50%, but then you have to factor in that dilution. So revenue per share is about 25 to 30% after the dilution. So still great growth on the top line, and margins have only gone up essentially since then. Very unstable margins, which is part of the business and the industry, I guess, as well. But yeah, a lot of the growth is through acquisitions, but there is some organic growth as well. As they acquire more businesses, they kind of have more products that they can offer to existing customers and clients. So, say one of the things they do is roof trusses. If they acquire a company that kind of focuses on wall panels, then they can kind of pass that on and kind of improve their logistics line and offer more products. So that's kind of where the organic growth comes from, as well as a bit of pricing power and everything else as well.
Are they actually installing these products, or are they more of a distributor to the people who do eventually install?
Yeah, so they're kind of selling to the home builders essentially.
Okay, right.
Multifamily, single family, any kind of buildings that are kind of going up there, doing the production for them. And they do a lot of like prefabrication and things like that as well.
Given that the business has grown so much, I doubt we have much history to see how they maybe navigated harsher real estate times, which we may very well be heading into. How are you factoring that in? How are they factoring that in? Because that's obviously a concern top of mind right now for anything kind of adjacent to real estate.
So the business has been around since 1999. So they went through, I guess, the 2008 is the only relevant time period. There's not a lot of data about that. Obviously, it wasn't public.
Mm-hmm.
And as far as I've seen in my research, I don't think there's too much available on that. But the fact they got through that and kept growing or kept surviving, I guess, at a bare minimum,
Sure.
is a good sign. But like I said, I don't know how much the housing market actually came down during that time period. Obviously, building doesn't just stop all of a sudden overnight. So even if you see a 20 to 30% pullback in the housing market, which is probably worst case scenario.
I don't know about worst case. It could get worse, but like, sure, that's a reasonable assumption.
Yeah, maybe I'm being a bit too optimistic, but then you just see a big pullback in the company, obviously, but I don't think it disappears overnight. Right. So the company gets through. Maybe it looks rougher than you would want it to. But yeah, I think it also creates opportunities for these acquisitions that they're making. Being the kind of market leader or one of the biggest companies, and having that scale advantage, they're the ones that are going to survive. It's these smaller mum and pop businesses that the industry is made up of. I think there's about 6,000 companies roughly, all very small companies. So they're just going to be on sale essentially. So it is a bit of an opportunity as well as a problem for them.
Yeah, I was going to ask that next. Given your Kelly Partners background, and they're very similar, at the high level strategy of rolling up independent mom and pop type shops. Then for Kelly Partners being on the accounting side of things for accounting businesses, this would be wood businesses, I guess, framing and that sort of stuff. How segmented is it? You said there's 6,000 businesses. Is that like the majority of the industry? Are there some huge players here in Canada? Do you know what that looks like?
Yeah, so I've just got the numbers in front of me now. There's 6,309 wood product manufacturing businesses across Canada. It's a $2.5 billion industry, and the average revenue for each of those is only $700,000. So being I don't know their exact revenue. I think it's 60 million roughly. They're the biggest player I've come across, at least public. There's no other really major players. I guess there's a few that own a handful of these businesses, but most of them are just single operator, $700,000 revenue businesses, with a lack of they've been unable to add the automation and prefabrication strategies into it just because it's capital intensive. They don't have the capital available. So they've kind of run the business the way it has for the past 100 years, I guess. Without being able to improve the technology side, I guess, of the business. Sure. And a company like Atlas that has the capital available, they've been able to do that. So they see better margins and that helps them get through some of these labor shortages and things as well.
Cool. So yeah, I'm trying to think. So they're not like going up against a Titan or something like that. It's pretty segmented, and they appear to be kind of the first mover, sort of leader, and they've got some serious momentum too. With the rising cost of debt, is that a concern too? Well, I guess they're throwing off some cash flow, but if that cash flow decreases a bit because of market headwinds and the cost of debt is now increasing, does that just does that slam on the brakes? Do they have any sort of plan they've articulated if things were to slow? Probably, I don't know how much they would care to say, but I guess I'm trying to say, are they do they have a pivot in mind if debt becomes too much? Would they just start raising capital through debt, or through shares, or?
So it would depend. They won't do it through shares at the current price. The management have said that. So
yeah, right. Yeah, you said that.
It would kind of just be it would be a bad capital allocation decision to do that right now.
Mm-hmm.
Worst case scenario, if debt was not worth it, they just wouldn't acquire any businesses over that time, and they would keep that organic growth going, and you would see slower growth, but probably improvement in margins. Part of the margins are hurt through this quick growth. They acquire these kind of poor businesses and make them better. Essentially, they almost double the margins on a lot of these businesses. So you would just see maybe the bottom line or margins improve and the top line kind of slow down as they stop making acquisitions. But most of their debt is at relatively good rates so far. And that goes out over 7 to 10 years, most of those loans. A lot of different banks and stuff involved. They've got a good relationship with a new Canadian bank, and that helps that they're kind of at the size now where I guess they can get a better deal. But yeah, worst case scenario, the acquisitions slow down, which isn't the end of the world.
Sure. Yeah, they got a good foundation going, and they're not like dramatically over levered, and that's good to hear on the debt terms. Cool. Now would probably be a good time to maybe reiterate why would you look at this niche, tiny stock, not highly traded? Why it's all illiquid? Isn't illiquidity a bad thing? Like, why look at these sorts of stocks? Give you the soapbox, Frank.
I guess the last thing I'll touch on too, and this is partly why the stock's interesting, is it trades at 3 times or less than 3 times EV to EBIT at the moment. So
sure, yeah,
there's a huge chance of a multiple re-rate, and part of the reason I look at these smaller liquid stocks is I think there's more inefficiencies, or almost without a doubt, there's more inefficiencies. The less people that are covering a company, most of these small companies don't have any analysts following them. Large institutions can't access them, so there's a big chance of inefficiencies, and that can go both ways. That could be being overvalued or undervalued. But yeah, when there's only a couple of hundred shareholders and they're mostly retail, mostly inexperienced, yeah, there's obviously a better chance of scoring a deal, I guess. And I think this might be one of those. I don't own the company, full disclosure. It's still top of my watch list. The main thing, again, the only reason I probably haven't is that labor shortage problem, which I just don't know how they solve. Even in some of the calls and interviews they've done, they mention it as their biggest risk and don't really say exactly how they're going to solve the problem. They kind of just accept that it might hurt their margins, which to me isn't the best thing. Everything else is great. I think the acquisitions in that fragmented industry will go really well. I think the valuation is really low. When they listed, they were about 10 times EV to EBIT, and the shares just gone sideways, and obviously a lot of growth come through. So
yeah,
if market conditions improve, and eventually they're going to, I find it highly unlikely. Yeah, it could be 5-10 years, whenever it is.
Right, exactly.
When those market conditions are better, or if this growth continues, 3 times EV to EBIT just doesn't make any sense.
Right. Quick question on the management team. Have they done? Is this like a found? I forget what you said towards the beginning. This is a founder-led business? Has he done anything in the past that might be indicative of anything?
Yeah, so Hadi Abbasi is the founder of the company.
Right.
He come from Iran, went to UK and did an engineering degree, moved to Canada and was working as a janitor at McDonald's. So a classic entrepreneur story, I guess.
Yeah.
He bought the company for $45,000. It was just a single company. And then obviously he's grown it into a $60 million company now. So he paid
30.
Oh, sorry, 60 million in revenues is what I was going to do.
Sure.
And and it was 90,000 in revenue at the time. So he paid like half of sales for the business originally.
Yeah.
Yeah. So he's been a great capital allocator over a long time. He didn't sell shares that entire time until just recently. He's got like this slow kind of funding his lifestyle, I guess. It's not a massive problem, I don't think, unless it happened really quickly. But he's an older guy. He did step down from CEO at one point. They had a temporary CEO in there for about a year and a half. Didn't do the things, I guess, Hardy Abbasi wanted to see, remained a big shareholder. So he stepped back in as CEO. I wouldn't be surprised if he does find someone else to remain CEO of the company. But I think Hardy will stay a big shareholder on the board, very active, and kind of slowly fund his retirement, I guess.
Yeah. How old is he, do you know, approximately?
I don't know off the top of my head, but around, just looking at him, around 60, I would guess, 50 to 60 in that range.
Yeah, I wonder, it's probably not a concern now, but I wonder how difficult it is for him to relinquish control on things, because he's clearly good at what he's doing. And if you get someone who maybe is like a B+ player, but he's an A player, that might be painful for a owner founder like that to swallow. I wonder if that will lead to anything in a decade's time, if he's really trying to relinquish. But anyways, that's a bit of an aside.
Well, with that CEO that stepped in, it wasn't extremely public with exactly what happened, but to me, it seems pretty obvious that Abbasi wasn't happy with what he was doing and got rid of him very quickly. It was like a 12-month period in and out. And until he got the right person, I don't think he'd be happy to just sit on the board and do not too much. He's remaining active.
That's what I'm getting at. He knows what he's doing, and he knows that. So it's like, it's tough to relinquish that. That's a skill in itself, but yeah. Cool. That is part of the, that is right out of the Kelly Partners formula right there. That has built this cult following in the investing with Frank, or no longer investing with Frank, no longer Frank Tabor, no longer on YouTube following that got you going with Kelly Partners. So if it ain't broke, don't fix it, right?
I guess the main difference between the two is this has a lot of exposure to the macroeconomic factors, I guess. Yeah. Kelly Partners is a pretty recession-proof kind of business.
Is it though?
Well, tax isn't going away.
Well, definitely more than like a real estate linked business like this. But if business activity decreases, then accounting services would decrease too. But yes, you're right. You got that sort of rock solid business and tax preparation and all that. But yeah. Anyways, it's a good business model, the roll up strategy in the illiquid side of things. So I like the pitch, and that's like, so it's a Canadian stock, so it'd be over the counter in the US and pretty much everywhere else. Cool.
All right, what you got for us, Jack?
Let's see. I wanted to do kind of a medium pitch on two stocks, just that I was taking a look at recently. I don't own either. One I've talked about on my channel some time ago, and another one I have not. I'll start with the one I have, and that would be actually HP. So this is the Buffett buy from a while back, and I didn't realize how much it has decreased in price since then. To where it's actually looking kind of interesting. It's not going to be a giant compounder, but here, let me pull up the ticker again. The screen is white. There we go. But HP has come down quite a bit. Year to date, it's down 33.5%, which is kind of crazy given that it's a kind of a stalwart. It doesn't really do a whole lot with like big swings in revenue or anything like that. If we go down to we'll start with revenue. Actually, for some context, HP's market cap currently sits at almost $27 billion. Buffett bought back in the summer, or was it even the spring? It was quite some time ago now that he made that purchase. And looking at revenues on the top line, they've been pretty just steady, tracking inflation and then some over the last decade, really, if we go all the way back. Well, that was after they did their spinoff. But since about 2014, it's been pretty steady. You're looking at somewhere between 50 to $60 billion in revenue, or more like $65 billion in revenue. Last 12 months, they're sitting right around there, 65 billion. And if we go down to free cash flow as well, just to kind of get a feel for what's going on, their free cash flow ranges from as low as about 2.8 billion up to well, I don't want to include 14, but up to
What
about.
did they spin off? Sorry, I just don't know the history.
It was I believe it was it was like their IT security services or something like that. There's two HP stocks. This is HPQ, which is more like the consumer side of things. It's more their tech software services sort of thing. That was spun off, if I remember correctly. That is not what Buffett bought. He bought HPQ, but HPQ, I believe, owns some of whatever that other ticker is for the other HP. I might be incorrect about that, but either way, looking at free cash flow, they're at about maybe it's 6 billion or so. Yeah, 6.3 billion in the last, or wait, that's net income. About 4.5 billion in the last 12 months. And that's after a very strong year in 2021, where they had about $6 billion in free cash flow. But just kind of looking at this range here, their low range is around, we'll call it $3 billion in sort of down years, as high as $6 billion in a great year. And right now hovering around that 4.5 billion. But let's say they get back down to $3 billion in free cash flow, just for some back of the napkin sort of stuff. $3 billion in free cash flow on about a $25 billion market cap. It's a pretty decent cash flow yield right there. Especially even in this market, which you could say is still kind of expensive compared to history. So if you're looking for kind of one of those steadier cash flow revenue businesses at a more and more attractive price as it continues to fall, and you're also investing alongside Buffett, I guess, it's an interesting one that I hadn't really considered when Buffett made the purchase, since I thought it was too expensive, but it's actually getting kind of interesting for if you're just looking for kind of like a maybe for portfolio construction, something that maybe doesn't have a ton of downside, doesn't have a ton of upside either, but hey, you're getting it at a decent price potentially, and with a decent cash flow yield, if that's something you're looking for. So that's kind of the pitch. I haven't really gone much deeper into it since I kind of just thought of it a couple of days ago. I'm like, hey, I wonder how HP's doing. I look at it, I'm like, oh, it's actually kind of cheap. So
being a mature business, I guess, with a lot of cash flow, are they just paying a dividend? Are they buying back shares, or what are they doing?
Yeah, let's
even if you pull out the cash flow.
Yeah, I got the cash flow here, but let me actually switch up balance sheets. What I want. Look at total shares outstanding. They have been buying back a lot.
Yeah, wow.
And they've nearly halved their shares in the past 6 years or so. Not half, but they're down to about 1 million shares, or I guess that's 1 billion shares. That's crazy. There's 1 billion shares floating around. But that's compared to 2015 when they had about 1.8 billion shares. So they've been buying down pretty aggressively, and a lot more aggressively in the last few years. Back in 2019, they had about 1.45 billion. Again, they're down to 1.08 billion. So lots of share buybacks. And I forget if they actually have a dividend on top of that, but I think they do a couple percent, if I'm not mistaken. Where's dividends again? It's in
valuation will tell you the dividend yield.
Yeah.
Otherwise, cash flow statement as well.
There we go. Yeah, about a 4% dividend. When Buffett bought it, I feel like it was around the 3. Yeah, it was. 3% dividend, that's on top of the buybacks. So you get a 4% dividend on top of that. So again, just sharing that cash flow with everyone, not really trying to grow the business necessarily as something like an Atlas, which is in pure growth mode. This is kind of a ride the wave sort of company.
Could you pull up the cash flow statement just for a second?
Yeah.
Just curious how much dollars wise they're putting into buybacks. Scroll down a bit.
Mm-hmm.
Repurchase of common stock. So yeah, 5 billion, 6 billion the year previously. So that's like what kind of yield is that? That's a lot of the market share, isn't it?
Yeah, it is $25 billion market cap. So about a quarter of the market cap. So yeah, aggressive buybacks relative to their market cap. and they've been accelerating, as you can see by the numbers going up.
So just between the buyback yield and the dividend yield makes it pretty appealing, as long as the business doesn't disappear, which I don't think.
Right, and I'm kind of using that $3 billion as sort of their floor. It could go lower, of course, but just looking at kind of their worst year in the last 6 or so, it's been about 3, and it's been as high as almost $6 billion in free cash flow. So you got some room, and right now it's about 4.5 over the last 12 months. So if it maintains that, like it's a pretty decent yield there. And if they continue to buy down the shares and then also pay you back with some actual dividend yield, you can make a decent return potentially, as long as you don't see some crash elsewhere.
Yeah,
and
I like it, really. It's that pretty standard kind of deep value, retiring shares, cash flow yield. I think people put it in the chat with Tobias Carlyle, I think, owns it.
Yeah, I wouldn't be surprised. The next stock is a Toby Carlyle pitch I heard some time ago, and I'm sure a lot of people did as well. But that one I haven't gone as deep into. But anyways, we'll get into that in a second. But yeah, it's not like an exciting business. They sell like consumer sort of office products, like printers is what they're often known for. But
is that the biggest part of their revenue, printers?
I remember looking at it a while back. Let me pull that up. I wanted to say like half was desktop computer and laptop computer type stuff. But that spiked during 2020, 2021 when everyone was at home and probably needed more laptops. But they make quite a bit on the enterprise side of things, selling to businesses. HP revenue splits. Here we go. Please don't be behind a paywall.
Matt H said they have a segments tab in Ticker. I'll pull that up while you're doing what you're doing.
Yeah, I got it on Statista here. Got to move it to the other window. I'm still on one monitor. It's easier when I had two.
Here
I got it right here.
Oh, yeah.
In color code. But it splits personal systems at 43. That would be $1 billion. No, 43%. Sorry. No,
that'd be billion.
No, it is billion. Yeah, $43 billion. And then 20 billion in printing, which has been very steady. The printing business is extremely steady, between 18 and about 20 billion over the last really decade. And you can see this is what they spun off: the enterprise services and more of the services sort of section of the business.
Yeah, I like it. It's not the type of business I would buy, but it's the type of business that makes a lot of sense.
Right.
Depending on your strategy.
Like, it doesn't make me super excited, but I think it's worth keeping an eye on. Just if you're, it's definitely not a Frank Tabor stock. It's a large cap, or definitely large cap.
Mid cap.
Mid to large. In this market with $1 trillion companies flying around, so you're not going to get like that huge, massive compounding growth. Definitely not, unless something wild happens. Hyperinflation, I guess, right? Nominal gains. But it seems like it's still worth a look if you're looking for kind of something to slide into a portion of your portfolio. Just want some kind of stable with some okay upside, not a ton of downside, perhaps. I think that's the pitch. At least that's how I would look at it, but to each their own.
All right, what's the next one then? Is this your best idea or second best idea?
I mean, so I saw in the chat someone wanted to say Sleep Number would probably be my first choice. It probably would be, but I already said Sleep Number, I think, in the last episode. So just to kind of mix it up a bit, wanted to look at some stocks that I don't actually own, that I've heard about recently and had done some and know something about, and maybe not a ton, but just because I thought they were kind of interesting. But the next one, I mentioned it was a Toby Carlyle pitch. He did on the Investors Podcast Network. I forget when it was, but it wasn't that long ago. But it was actually First American Title, or I guess it's First American Financial Corporation, which owns First American Title, which owns a ton of the title companies throughout the U.S. which I work with quite a bit for my job. So it was near and dear to my heart, given that it's very close to my career. So just for those of you who don't know, in the U.S., when you buy a piece of real estate, you get something called a title insurance policy, and that kind of guarantees that the title that you're buying is clean of other people's claims and that sort of bad stuff that you wouldn't want when you buy a piece of property. It's a little more complicated than that. They issue what's called a title insurance policy that has plenty of exceptions on it, but it's kind of this routine thing that happens in every real estate transaction, at least every reputable one. And basically what First American Title...
Sorry, could I just stop you there for 1 second? What percentage of these don't, like, what people don't use title insurance? Like, what percentage of real estate deals has it?
That's a good question. I've never heard of not.
Okay, so it's like most of them that.
I've never heard of not going through a title company to actually close a deal. Okay. Just because it's very routine. It's really not all that expensive when you're considering like a multi-$100,000 transaction or multi-million-dollar transaction. You're going to be paying a few grand probably in title insurance, or it scales up just like any other insurance policy with the size of the deal or the size of the loan. A lot of times these things certain policies are required by lenders. They're not gonna lend on a property unless they get a title policy and what's called a lender's policy, which is very similar. They're kind of guaranteeing the mortgage as well. So it's extra coverage. But anyways, point is it's ensuring that you have clean title up to a certain point. And what they typically do is they'll look at like the public records of a stock. So we have like a recording system in the US where each state or county will record things that have happened to the property, like when it was transferred to someone else, if there's like an easement or some sort of encumbrance on the property. This is all recorded. The title company will go through all those records and see, okay, we found this thing where someone might have a claim. That's an exception to our policy now, unless you can somehow clear it. So that's how they protect themselves as a company. They look for those things that are already on record. They have them as exceptions to the policy. So if someone comes and tries to assert some publicly recorded thing, it's not going to work. But if there is a claim against the property and it's covered under the policy, then the title company would have to defend the owner that they insured against that person making the claim. And if that person making the claim is successful, then they'd have to pay out whatever the policy says to pay out. So it's like any other insurance company. It's just very specific to real estate with some specific nuances. And speaking of roll-ups, they've kind of run a roll-up strategy in buying title companies all throughout the US. And they're, I think, by far the biggest in that they bring in, let's look at the numbers real quick. They bring in billions of dollars in revenue, but it's very transaction oriented. So kind of like the Atlas pitch in that way. It's very linked to real estate, but just looking at premiums that they've brought in. And speaking of which, it's a one-time premium. Typically, it's at purchase. You pay the one-time premium. It's not like an ongoing thing like you might have with, say, car insurance or homeowners insurance. It's a one-time thing, and you're insured for a very long time with the policy. It's kind of a snapshot in time sort of policy. But they brought in about $7 billion in 2021 and about $7.5 billion in the last 12 months as well. So definitely big years for transactions. And as I mentioned, there are lender policies as well. So even if there aren't a bunch of straight up purchases and sales, you also have the lender side of things. So when things get refinanced, so if you get a bunch of rate changes, you might see a bunch of refinancing, which they would benefit from too. So they do have some of that covered, even if transactions slow down, as long as they get a bunch of lending transactions too. They still have, I guess you'd call it downside protection there, or potential upside, however you want to look at it. But let's take a look quickly though, just to see how they are definitely affected by real estate. And this very much looks like the real estate cycle. Zooming back to 2007, revenues were like $6 billion, down to 3.5 in 2008. But hey, that's still not so bad. They still brought in $3.5 billion in a horrific real estate environment.
So a quick question, just so I don't really understand. Well, I'm getting it as you talk about it, but I don't know
Sure.
too much about this. It's a percentage of the real estate deal,
No, not exactly.
so
Let's
it's
say
not completely tied to the price of
it,
housing or
well,
real
it
estate.
is. Like, if you're buying $1 million property, they're going to insure, say, $1 million of coverage or whatever the transaction value is worth. So it is tied to that, but it's not as simple as like, oh, it's a percentage, because it depends on what kind of coverage you get, because you can get extra sort of endorsements on your policy that cost extra, and extra sort of guarantees and all that stuff. But yes, generally speaking, you could look at it as a percentage of the transaction, but it's a little bit more complicated than that.
Yeah, no, cool.
Sorry
Makes
if that
sense.
answer is less than satisfying, but and the same goes for the lender side of things. It's very much tied to the dollar value of the transaction. So it's very much a cyclical stock, and you could say pretty clearly, we're at the top of a cycle. How deep it goes after this, who knows? And it could always go right back up. But it seems like transactions are slowing down a bit, or at least there's some uncertainty as to what's happening next. Because this is both on the residential and commercial side. They do all sorts of stuff in states all across the U.S. So you can kind of look at them as the market. They're going to be affected by the aggregate U.S. real estate market and mortgage market. So if that goes down, they're going to go down too. But if it goes up, they're going to go up too. But they have proven that they have some resiliency just in dealing with that horrible environment from 08 to, we'll call it 12, when real estate was not all that great for transaction volume and also just dollar value as well. So that's kind of the general high level pitch. And the question would be, looking at their free cash flow, is it cheap enough, considering that we might be at the top of the cycle and that things might get a lot worse from here? They brought in about $1 billion in free cash flow in 2021, and scrolling to last 12 months, it's already down to about $760 million in free cash flow. And that is on, as I mentioned up top, or I think I mentioned up top, on the $5 billion market cap.
And they're retiring shares as well.
Yes.
Having a look. I think they're buying back about a 5% yield or something.
All right, let me slow down. Let me narrow this view back to 6 years. Looking at total shares outstanding, they've been pretty steady, except in the last year, as you mentioned, they bought, we'll call it about 5%, like you said, of their shares outstanding.
300 million, so whatever that is to their market cap. I forget their market cap now, but
5 billion. So
okay, yeah,
what is that, like 7 or 8% ish, something like that?
Yeah, sorry, yeah, and then a dividend yield of about 2 or 3% by the looks of it, maybe more.
Yeah, here I'll pull up the valuation so it tells us right away.
But so some of their growth is
4.5%.
Yeah,
in the last couple of years, it's a bit higher than
some
that.
of their growth is coming through acquisitions. You said, is that right?
Yeah, I'm not sure how many acquisitions they've done recently, but they own tons of subsidiary title companies. So, and that's because the market is kind of segmented. Like every state is going to have their own nuances. So almost like banking, you're going to buy like the local bank, you're going to buy the local title company. It's kind of that sort of feel, if you will. So they own a bunch of subsidiary title companies all throughout the nation, and apparently 49 states, so not all 50, 49 states, and District and Washington D.C.
So I'm just looking at the cash flow statement now from like their call it 900 million of cash from operations. They essentially split it 3 ways between acquisitions, buybacks, and dividends. So it's kind of capital going each way, which is pretty interesting.
Yeah, it's like how do you grow the business when you get to this level? Like you can only get so far with before you kind of not corner the market, but before you just have so much market share, it becomes hard to grow. And that's kind of how they're breaking it down. Return some capital to shareholders, still work on some growth. but pretty measured, all things told. So that's it. It was interesting because Toby Carlisle was pitching it, and I'm like, that's funny because like I work with these companies all the time, like every day. They are kind of the rock of pretty much every transaction. Them or their competitors as well. They're not the only company, but they're, I think, by far the biggest. I think the next biggest might be Fidelity National Title Group. I'm actually not even sure if they're publicly traded, but
could you pull up the share price? What's it done since like this real estate kind of
sure. Here, let's
potential is
here, look at the 10-year. Going back to, well, what about all time? Going back to 2010, they're at about $14 a share, and it's been a pretty steady ride up from there. But zooming in a bit on the last, we'll call it 3 years. So this goes back to 2020. They had a dip there. It's loosely follows real estate, I guess you could say, which makes sense. And it has fallen quite a bit since January of 2022. So this year to date, they're down about 40%. It's actually quite very similar, I guess you could say, to HP in that sense. I think HP were they down 35% or something in the last year, or year to date, I should say, not even a year.
It's a somewhat similar thesis, I guess, isn't it?
It is. That's why I thought it was somewhat appropriate to say both, because they're kind of similar, but just completely different industries, but similar sort of overarching narrative, like decent downside protection, just because of the quality of the business, I guess. And I would guess First American might have more potential upside as they continue to roll up compared to maybe an HP, but I'm not sure how much beyond this.
So I'm just looking at a historical PE ratio. If you want to pull that up, it looks like it's the cheapest they've ever been.
And that's probably because revenues are inflated, perhaps.
True.
Yeah. So you probably have to, if you're trying to be conservative, you'd want to discount somehow transaction volume going down, or at least the dollar value on those transactions going down.
If you see a 30% pullback, even looking at a multiple like that, it still would be cheap historically.
Yeah. And that's the pitch. It's like it seems pretty cheap historically, even if you factor in some more significant pullback from here in real estate, which a lot of people are expecting. Whether they're right or not, we'll see. But this is one I'm definitely going to keep an eye on, just given how closely I work with First American brands, and the experience has generally been quite good. And frankly, there's not a whole lot of other options a lot of the time, since a lot of lenders have a preference to work with particular title companies, and often it's First American brands.
Do you know market share wise? Is this like the largest player by far, or
actually let me look at that. I'm not sure for certain. I believe they're pretty far ahead, but largest title companies in USA.
Because if they have a large market share, then it's pretty safe. They're not disappearing. And
yeah, they are. I wouldn't call it by far, but they are the biggest. They got 21% of the market. Next closest would be 15% with Old Republic. Chicago Title is 14%. I thought they were under Fidelity National Title. So Fidelity National Title is 13%. So that they're not running away with it, but those are by far the biggest four players. After that, it's sub 10% for a handful. But they are definitely the leader in market share.
Yeah, so that's kind of similar to what I was thinking about with the Atlas. Is they're tied to the housing market, but the housing market, these deals don't stop just because of a recession. They slow down. And of course, revenues slow down with that a lot, but they don't disappear, which I think is the important part. So you have to counter that into your valuation and what the future looks like. But yeah, it's not one of those companies that are going to go away by the sounds of it.
Yeah, right. They're
particularly with that much market share.
They're very ingrained into the real estate buying process. Like you can't really get around title companies. They that is just how things are. So like they're not going to go away. Even if the real estate market tanks, there's still going to be some transactions. There's still going to be refinancing. What level it gets to, we'll see. But yeah, exactly.
Who's their direct client? Is it the actual consumer buying a house, or is it?
Yeah, So it'd be the buyer and the lender would be who is getting title insurance. So the new owner of the property, they're going to want to make sure title is clean, so they're getting the policy. And same with the lender, they're going to want to make sure things are clean too. Those are the customers. Typically, what happens from my perspective as an attorney, either if there's no lender involved, one of the side's attorneys will probably pick their preferred title company that they work with. Often it's either Fidelity National Title or First American for kind of then those are coincidentally the two biggest players. If the attorneys don't get to pick, the lenders definitely will, because if there's a lender involved, it kind of hinges on them anyways. So they're almost always going to get the pick as to who their preferred title company is. And then it's often one of the two biggest players, because at least on the commercial side, what I'm dealing with, we're dealing with big lenders. So they're going to go with the big title companies almost without fail. Though occasionally we'll get some niche kind of small local title companies, the ones that still remain. That probably will get rolled up at some point anyways. And speaking, I mentioned Fidelity National Title. Manu here in the chat is as well. He says Fidelity National Title is quite similar to FNF. I have not looked at their stock. I assume they're publicly traded. I have not. I was just kind of going off the pitch I heard from Toby Carlo, and I did some brief research into it after that. I was like, oh, this is actually pretty interesting. This is very much a starter. I haven't, like I said, I don't own either HP or First American, but it seems like they're worth a look. So I thought I'd share. That's kind of it.
I'm just looking, one more thing probably worth pointing out is those margins over time. There's been a lot of operating leverage. So I guess as they've kind of scaled, they've had to probably lower that SG&A cost, I would guess is how they're doing it. Maybe another cost, I'm not saying. But since 2007, obviously they were into kind of negative territory through 07, 08. Mm-hmm. But it steadily rose from about 5 up to about 18% operating income margin.
Yeah, last 12 months are at like 14-ish. And
again, that would be inflated, and that probably comes back down to say between 5 and 10% somewhere.
Yeah, in a bad market.
Worst case scenario type thing.
Yeah, but in the last 5 years or so, it's been 10 to 15 in that range. With the one-off year, 18.5% in 2021, like you mentioned.
And then gross margins have been like super stable at like 29, 30%. Mm-hmm. Since they've existed, which is a good thing in these type of businesses, I think, is how stable margins are, or if they're rising, even better, usually.
Yeah, it's not it's a pretty niche business, so it's not like it's a race to the bottom. There's very few companies that actually do this. And it's kind of a weird business, I guess, because it's like you're giving out pretty huge insurance policies, just dollar value wise, but based on kind of like some preliminary day one research. And then what ends up happening, so for anyone who cares, the way it'll typically work is the title company will issue their kind of draft policy. They call it the title commitment. From there, the buyer will object to certain things on this policy, or I should say the buyer's attorney will. They'll object to things on that policy saying, hey, we don't want this on there. We want this exception removed so that we have more coverage. And they'll typically ask the seller, like, hey, do you have the documents we need so we can get this thing removed from the policy, prove to the title company that this isn't a problem? And then there's kind of some back and forth between the attorneys, either accepting or countering those objections, and getting the title company what it needs to waive any of those exceptions. So that's kind of like the process leading up to a sale. That's what a lot of time from the attorneys goes into, actually, in some cases. But that's kind of how the mechanics work leading up to it. So you do need to have some pretty specialized knowledge as like a title insurance issuer, because you're dealing with all these different sorts of restrictions on property. You got to be pretty thorough in what you're looking at. But it's really just kind of like a research project going into it. You just look at everything that could be affecting this property, try to cover your bases, cover your liability as an insurer, and go from there. So you got to be pretty thorough, and you got to have a pretty thorough team with that. So I guess that's where some of the competitive advantage is, just having more resources at your disposal.
I like that pitch. I do like that one better than HP. I'll call that one your best idea for you.
All right, sounds good. Maybe it's because I haven't gone particularly deep in it, but just being around it, I like the feeling. We'll say I got a good feeling, so it's definitely one that I would be interested in going in further, especially if the price continues to come down. But you could say that about a lot of stocks right now.
We're getting a bit of hate in the chat for not covering a Turkish company. There was an offer from Eunice for $100 donation if we picked a Turkish stock. But
Racist is a stock, right? Can we get our $100 now?
Surprising thing I found out the other day, it was actually after the Punch Card show last week. Me, Tom, and Jason were just talking for a little bit. They've had real GDP growth. They've had 75% or something inflation, whatever crazy inflation number there is. But somehow
I could
real GDP growth. That's insane.
I could see it. 1% growth is growth, real growth. Or whatever it was.
It's absolutely insane to me that they've managed that.
And I mean, governments are finagling with the numbers all the time. Like, the U.S. government likes to think that we're not in a recession because unemployment is too low, and unemployment the way they measure it, of course. So there's you always got to take that stuff with a grain of salt. But yeah, nominal gains, those are always fun. That's one thing I think about with like the stock market over like the last 40 years. People talk about all the amazing gains, and you think like, how much of the gains were nominal and just underreporting inflation? And really, we've all been sitting on like 2% real gains, but it doesn't feel like that because the nominal gain's higher. But yeah, doesn't matter, I guess. It's a lot better than sitting on worthless dollars 40 years later.
Yeah, I think Turkey would be wise to report their inflation slightly under their nominal growth.
Yep. Right, exactly.
Just so the situation doesn't look as bad.
75%, 70%, what's the difference at that point? Like, come on.
I'm curious what Eunice's thoughts are there. This is something that I'm talking well out of my circle of competence right now.
Oh, yeah. I hear all the high level stuff. I have no boots on the ground knowledge, nothing. It's all just whatever the media shares.
I'm just scrolling back through the comments. If there's any questions anyone wants to ask, even if they're not to do with our best ideas, happy to dive into a few in the last couple of minutes.
Oh, I realized I never mentioned HP's debt. I saw a comment about the debt, so I'm pulling it up right now. I've got long-term debt of about 10 billion, so it's a fairly large chunk compared to the $25 billion market cap. Nothing crazy, and also compared to their 5 billion or so in free cash flow. So it's significant, but nothing insane, but worth considering as always.
There's a few comments about SWBI, Smith & Wesson, I think it is.
Smith & Wesson. I own that one.
Right.
I wonder if it will jump after the midterm as it often does.
Was this a previous best idea of yours on here? Or?
No, I don't think I've ever pitched it. I think we talked about it very briefly with when Norbert Liu, he bought in quite recently, like a quarter ago or something. It's a weird one. I don't know how I feel about there's obvious controversy with it because it's guns, but it's a super long-standing brand, and there are huge portions of the country that will never let it go. We'll say, and it's an interesting business with like I said, a very long-standing brand, and the numbers look very cheap. But granted, it's a controversial stock, so it's probably going to lag the market no matter what. From like a multiple.
Is it like the biggest gun manufacturer in the US, or is it bigger?
No, I don't think it's the biggest. It's one of the biggest.
And it's like consumer facing, right?
Yeah. Yes. What is the biggest? No, Smith & Wesson is number one.
They're not doing like military stuff or anything. It's just consumer brand.
Yeah, police as well.
Okay.
But yeah, no military. Remington number 2, Sturm Ruger number 3, Sig Sauer number 4, Mossberg 5, Savage Arms 6, Springfield.
What was number 2?
7. Remington.
So the only brand I've heard of is Smith & Wesson. So as an Australian, that must mean something.
Haven't heard Springfield?
No, well, from The Simpsons, that's about it.
No, I thought you were a Call of Duty guy. The Springfield rifle, that's another long-standing one. And then Beretta is number 8. I thought. Oh, that's interesting. Because Beretta's not U.S. They're Italian, but I guess they produce in the U.S. or something. Taurus 9, Glock 10, Glock's Austrian. I don't know how they're how they're. It's the biggest gun companies in the U.S. market, so it's including foreign. But anyways,
so they're trading at 4 times earnings at the moment.
Yeah,
very Why are they so cheap right now?
Well, you got inflated earnings, perhaps, and then also if it comes and goes with controversy. It seems like the more controversial something is, the more chance for regulation. Then it actually tends to go up, like in anticipation of people running to buy guns. I guess it's just a very strange. It's a strange industry. I wouldn't
link to like. Does their share price move with the Democratic and Conservative?
Yes, very much so. Yeah, very much so. It's just kind of whenever elections come up, it tends to be very volatile. I wouldn't be surprised if this election is the same as Luis was suggesting. But definitely with presidential elections, it always tends to swing. It's a weird one. I wouldn't want it to be half my portfolio, but just given the numbers, I was like, all right, I think it's worth a look. I'm comfortable enough having a decent portion of my portfolio in it. I guess Norbert Liu is too, with this little position he has. So it's not for everyone, but it's interesting.
Do you own a gun or a Smith & Wesson in particular?
No, not yet. I may soon, but I do not. But now that I'm in Texas, I did go. So I went to get a haircut, and right next to the haircut shop was a gun shop. So I went in just to ask like what the process was like, because Illinois, it's very cumbersome. And like you got to wait like many months to get like an ID card and all this. In Texas, I was like, all right, what do I have to do to get one? Just for my knowledge. She's like, oh yeah, I just kind of put your name in a computer. Usually comes back instantly, and then you can walk out of here with pretty much whatever you want. I'm like, this is crazy. It's just kind of amazing. Like when you coming from a place where that was not normal. And like just the amount of people armed here is way higher than in Illinois. Murder's down, I guess. Murder's down compared to Chicago. Interesting how that works. But yeah, it's a weird culture thing here in the U.S.
Yeah, from the outside, it's pretty crazy.
No, it is. Even from the inside, it's kind of crazy. We heard about Tom's experience going to the range in Texas. Yeah, it's a weird thing without getting too deep into it. And you mentioned Ryan here mentions contracts for military as well are obviously lucrative, but that's not something Smith & Wesson has done, at least for any time recently. It's mostly on the consumer side and then police.
Eunice just commented a Turkish stock, Age SA, said Monish owns 40% of the float. I'll pull it up on ticker. Look.
I will as well, HSA.
Pension and life insurance business primarily in Turkey.
There we are. Let's do okay. So here's the let's look at the currency changes. We got in lira, we're talking about a 53% return over the last year, and if we go to dollars, negative 26%. Fun stuff. Nominal gains. See, you feel good about yourself here with your nominal gains. Then you put in, dare I call it real terms, in dollar terms, 26% down. It's funny stuff.
Eunice in the comments, if you just want to do like a real short comment, tell us what you like about it. I'm actually curious about, I'd be more curious in Turkish companies that have exposure outside of Turkey, because you would assume the market's
less currency risk.
Yeah, less currency risk, but also the market's probably undervaluing them because there's a link to Turkey at all. So
Yeah,
there
maybe
could
so.
be some unique benefit there. But yeah, it's hard for me to get comfortable in a market I don't understand, that inflation numbers are just so high. Probably Yunus, coming from Turkey, obviously has a different outlook and a better understanding of that. But I think it would take a lot of work to get comfortable investing in any Turkish company, regardless of the quality.
I mean,
Obviously, there comes a certain price, but
yeah, just taking a quick look at the numbers. Revenues, this is in dollar terms, up almost 20% per year. And seeing, oh wait, there we go, balance sheet. They got a bunch of debt, perhaps.
Pays almost a 10% dividend yield, which is pretty crazy.
Yeah, that is kind of crazy. Are they newer? Not seeing any dilution, but this might be a reporting thing. That's different.
Trades at about 6 times earnings.
We're looking at about $89 million in free cash flow over the last 12 months, and that is kind of volatile. 2019, they were at about 116 million. 2020 down to 64 million. 2021 up to 73, now up to 89. So some serious fluctuations in free cash flow, and that's compared to a $280 million market cap. So, yeah, I don't really know anything about the business, but it's insurance, so depending on what their base of customers looks like, I guess it's all risk management. But it's been around for a while, since 1941 it was founded. Yeah, I wouldn't dare make a.
The contracts are written in US dollars, he said, so the revenues are stable.
Okay, that would, yeah.
They're the type of things you want to see in a business in
Right.
Turkey, I guess. But
do a lot of businesses in Turkey operate on dollars or euros, like almost exclusively? I wonder there. I know there were some like incentives to turn in dollars, use lira or something a while back with keeping rates. There was some sort of bond issues. I thought that was like inflation protected or something. That was kind of crazy. Just to try and encourage the lira to not get super weak while they were keeping rates down or something like that. I forget what it was, but I could be wrong. Could be mixing that up with something else. Yeah, Eunice says the economy is very dollarized, which would make some sense. 80% of bank deposits are in US dollars, for instance. Wow, that's kind of crazy, considering they have their own currency. I wonder how does that compare to the rest? How does that compare to the rest of the world? Developed or undeveloped?
Yeah, no idea. I assume that's really high, though.
Yeah, that's got to be. And I would imagine that the euro would have had a bigger. Granted, the euro and dollar are very closely linked, but I would have thought there'd be more in euro. The more you know.
Would you invest in Turkey, Jack, or is that just a quick pass?
I mean, for now, I guess it's a quick pass. Maybe it shouldn't be, because if I'm willing to invest in China, I don't know why, I wouldn't also be willing to invest in Turkey. I just haven't bothered to kind of learn about different risks and companies there. But maybe it's worth it. I just haven't bothered. Lots of things to look at.
Yeah, I guess it's the type of market that creates opportunities.
Yeah.
But yeah, it's hard to get comfortable. I've had a quick pass, mostly because I don't think I can even access Turkey from Australia. I don't think Interactive Brokers, you can buy Turkish stocks. So
yeah, I remember with, at least here in the US, I think Fidelity had some decent access. I remember when Brad went on this adventure to buy Races or figure out how to buy it. Fidelity had it through their like international desk or something. So that was for Races. I don't know if that's different for other Turkish stocks, but might be a starting point here in the States. Not sure about elsewhere. Interactive Broker seems like the go-to for broadest access, but even that has some holes. It's the same here as well. Interactive Brokers has good coverage, but there's never going to be one that has 100%, unfortunately. Fill in the gaps elsewhere. Maybe take a couple more questions before we wrap up here. Or
there's a bit of talk about weed stocks have gone pretty crazy lately. They're all up about 50% on the news of.
With the decriminalizing or they're pardoning a ton of people, releasing them from jail, or federal prison. I guess it's a federal level stuff. I think I only saw the headlines. They're getting higher and higher and higher. Dare I say?
The real problem with those weed stocks is a lot of the taxes and things they have to pay. And just regulation state to state until everything's kind of federally normalized.
It's still federally illegal. So like until that, like a lot of banks aren't comfortable with it. So it's just a very strange thing, just because like the stroke of a pen could do some crazy things.
I do think it's only a matter of time until all of those kind of regulatory things smooth out over time.
You would think.
Yeah.
It seems like that's more likely than not, but there's still like a significant chance it doesn't. You get a few different senators in, and all of a sudden it's gridlocked again. Or
a lot of them are unprofitable as well too, so it's hard to get comfortable. Air Wellness is one I looked at in the past, which that was profitable at the time. Don't know if it still is. It was extremely cheap, obviously for a range of different reasons, but I don't know. I passed on that one, but maybe in hindsight, with this good news, it would have been nice to be holding that. Actually, haven't checked. I might see how much that's up.
Oh, by the way, just to our Fidelity conversation, Eunice is based in the U.S. and he says he buys through Fidelity for his Turkish stocks. So good to know. Fidelity, there's a pitch.
Air Wellness over time, their stock chart's pretty ridiculous. Since 2021, it was $40 per share, went down to about $3 per share, and now that boost got it back up to $4 per share. So it's back on track. If you type in AYR, it should come up. AYR Wellness.
Is it Canadian?
It's an American company, but trades on Canadian Stock Exchange because they still can't trade.
Oh, right. Yeah. Yeah. Let's see here. Jeez, it's like a mountain. Pulling it up right now.
Yeah, so I was looking earlier this year, around May-ish, which when it was cheapish.
Okay, year to date.
Share price was. It's been a rough year, as everything has been.
If you just look at the last couple days, you're like, wow, it's almost doubled. Then you zoom out, you're like, oh yeah, law of large numbers or whatever. Should we ever have a full episode dedicated to these sorts of stocks? That would be something. I don't think YouTube would like that.
PE we did 1.5 juniors.
Yeah, we can do like the alcohol, tobacco, and firearms episode. Just just put it all in one episode.
Easy way to get demonetized.
Yeah, right. Exactly. Cool. Any final thoughts, Frank? Any final words of anything to share?
No, my main thing is I don't want to let these other three get away with not being here. I want to hear these best ideas.
Got to put them in an arm bar real quick. Man, make them tap.
Next week, I think if the audience can pressure them as well, we can sneak out a few more best ideas next week.
We're going to ask you all for a favor in the chat, and if you're watching beyond the chat as well, do be sure to pester Tom, Brad, and Karan next week, or if they chicken out next week, gotta hold them to it the week after that as well. However long it takes.
Tell Karan he can't get out of it. Tell Tom he can't talk about Thor. It needs to happen.
And what about Brad?
He normally has an idea in there. But I can't critique him too much.
Yeah. He covers
He needs to
all.
turn up though. He needs to turn up.
Yeah, I know.
Just got to get him out.
he's been spotty since that move. Granted, it's like 12 midnight for him now. So I don't know. We're going to be on daylight savings soon, so that'll help at least Quran here in the States. All these time changes this time of year make it so awkward, like trying to figure out what time's what time is when. Got a DoorDash Quran some coffee for next Friday. Well said, Matt. We'll go ahead and do that. Alrighty. I think that's a good spot to wrap up. This was nice. It was just the two of us, Frank, and I think we had a great time. I had a great time. I think
we upped the quality on these best ideas today. So
yeah, and we still got 3 ideas too. You know, I gave a bonus idea just to kind of balance it out a bit. So, and maybe something gets something out of it. But if not, I certainly enjoyed your pitch, Frank. So thank you for that. And thank you, Matt, for the super chat. Is that going into our punch card meetup fund? Whenever that happens around Berkshire time, is the current plan. Nothing concrete. We'll get back to everyone with some details as the months go by. But thank you, Matt, as always. But thank you, everyone. Check out the stuff in the description below. Go all the good links down there, including the affiliate links to ShareSite and to Seeking Alpha. You get some discounts there. And also check out the Discord if you haven't already. That is free to join. And if by chance you aren't in it already, Frank started getting more active recently, and that's exciting. Oh, I love to see that. I saw that. I'm like, great. So we're it's always very active in there regardless. So go ahead and check that out if you haven't. Like, comment, subscribe. And until next time.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.